And a very warm welcome to our first panel of the day. I'm delighted to be joined by three luminaries of the lending market who will share their insights into the later life lending sector with us. They are Esther Dijkstra, Managing Director of Intermediaries at Lloyds Banking Group, Alison Pallett, Sales Director at Livermore Capital, and Les Pick, Head of Sales Equity Release at Canada Life. Thanks very much for taking part, folks. So let's plunge straight in with our first question. So, do you think the pandemic has changed the way older people think about their finance and housing needs? And is this likely to result in an increase in demand for later life products? That question to Alison first, please.
Okay, thanks, Paula. Well, I think really this splits into two distinct groups. So the over 55s who are still working, and I think they have, that's the answer to the question would be yes, that there has been some changes of view. I think many incomes have been hit, and savings into pensions has certainly been placed a little bit on the back burner, which could potentially be storing up some problems for the future. I think in the retired population, the answer is also yes. And I think for those people that there's been a lot more time to reflect, and it has in effect pulled people's plans a little bit forward. We've seen a lot of people who've been raising money to help family members or for home improvements. And I think one of the major benefits of for the retired over 55s is the fact that pension income is set. So there's been a fair amount of conversation around this, that if you're drawing your pension, you know exactly what you're getting all the time. So I think the answer in both segments really has been yes, there has been some changes in terms of how people view things.
Thank you. And Esther?
Yeah, thank you. I agree with everything Alison has said there. I think just a build on it from me was a bit more, I don't think we all reflected on our housing needs, but we also probably reflected on life and death and our own frailty. So I think it probably was a time where more families had the opportunity to discuss things like that. And we all know that with later life, that's incredibly important, that it's this rounded discussion about what the needs really are of almost a family, because that's quite often, where the needs lie.
Thank you very much. And Les?
Yeah, I definitely agree with Esther there. I think it's given everybody the opportunity to kind of reevaluate their own mortality, and what's important. I think the feeling of family, when you can't have your family around you, when you can't see your family as freely and as on a regular basis as you might have done previously, I think it makes you think what's important about life. We've seen older people moving maybe out of city areas and that kind of thing. So starting to think about where they live, how they help their family. And I think that's going to be the big thing as the financial crisis, I guess, that may unfold throughout 2001 happens. So it's kind of their own mortality, what's important to them, how important is their family, and how can they support their family. And those are the kind of changes that we're seeing from the customers that we have and from the financial advisors that we speak to.
Yes, thank you. So changes of outlook. We've also seen some welcome progress in the later life lending sector in the last 12 months, with interest rates in particular plummeting, and initiatives such as daily interest payments on equity release from yourselves at Canada Life, for example. Do you feel there's more impetus in this market now? And what will it take to sustain much needed innovation? I'll ask that first to Les.
Okay, thank you. Yeah. Innovation in equity release. We've seen so much innovation in equity release. It's hard to see, with the flexibilities that exist, the safeguards that are there, the low interest rates that we see, it's hard to see how it could get better. I think the only way it could get better is, how do we increase LTVs? How do we make lifetime mortgages more readily available to those with interest-only mortgages, and that need for slightly more capital than they can otherwise raise. Rio does that, but if they don't have that income readily available on first death, then it's whether we can, as a sector, design some kind of hybrid product that gets those LTVs up but has that requirement to pay the interest in the early years. So I think that's the piece of innovation, that's the missing piece of the jigsaw that we probably need to try and find. Other than that, I think lifetime mortgages have done a phenomenal job. The lenders have done a phenomenal job at having a very flexible mindset and creating a very flexible product set over the last few years.
Great. And same question to you, please, Esther.
Yeah, I think I'll take it into a slightly different direction, if that's okay. I think, first of all, we've seen a couple of new entrants or re-entrants, depending on what you want to call it. And I think that's always good in the market. More competition creates more innovation. And what strikes me in this market is the needs of customers are really, really complex and varying. At one end, you could have, people thinking about their estate planning, etc. And on the other hand, you have people who are equity rich, cash poor, and need pension solutions. You have people who want to support their family, so intergenerational transfer of equity, money to get younger people on the housing ladder. So I think for me, it's key that it becomes much more, tailored to those individual needs of those customers, and particularly also around the advice process. So you have, of course, products, but I think also supporting those customers to get to the best solution, wherever their needs are. I think there is innovation needed in that part of the process as well.
Great. And Alison, what's your view?
So I think innovation is always the question, isn't it? And I think people are always asking for more innovation in the market. I mean, personally, we launched during the middle of this global pandemic, and I'd kind of asked the question of how much more innovative could you be than to actually launch a brand new lender during this period, as we've done. I think it's great to see the changes that we're seeing in the later life market. I think for me, the question around how we push this market onto the next level is when I look at the sizes of the mainstream market versus the size of the later life lending market, it's quite clear that we need to make real inroads into the mainstream side of the market. And I think one of the ways we're going to do that is around education, talking much more about this, helping people to understand more about the types of products and financial planning that are available to them, and just really increasing, brokers' knowledge around it all, the media getting behind it, and everyone just talking a bit more about this market. And I think from that naturally breeds innovation, because people start to ask more questions, and the more people who are engaged in the process, the better the thinking that comes from it. And that's always been my view in terms of it. But I mean, I think it's absolutely amazing to see, during what a tough year it has been for everybody, how the market's really kept going, and I think that's just a testimony to everyone who works in it, really.
Absolutely, I couldn't agree more. I'd like to come now to a question from one of today's delegates, if I may. It's no secret that the take-up of RIOs has been subdued. Is that simply down to affordability, given that only one guaranteed income, the lowest, is taken into account, or are there other factors at play there? Alison, what's your take on the RIO situation?
So it's a great question, and it's the type of question that we definitely need more people to be asking and more people to be talking about. Personally, I think it's more complicated than that. Our thinking at Livermore is very much around the fact that we have these two very distinct markets. So you tend to have this later life market and you have this mainstream market. And it's actually how you, in effect, get the two parts of the market to understand the other part. So I look at the equity release people that I talk to, absolutely brilliant in terms of understanding about pensions and later life planning and taxation and everything like that, but not so upskilled in terms of understanding affordability. And then I look into the mainstream market, and brokers in the mainstream market, absolutely amazing at understanding affordability and how that all works. And one of the things that we've really been working hard on is some simple questions to help mainstream brokers bridge into asking those pension questions. There's a real fear around asking questions about pensions, and actually gathering and garnering the basic information is actually not that tough. And you can easily run affordability calculators once you have some basic information around that. And that's kind of the mission we're on. But there is no doubt that death of first and affordability is a challenge. But I think one of the things that you need to understand is it's always important to understand the weakest part of the deal. And once you can understand the weakest part of the deal, that you can start to plan the mitigations around how you can overcome that. And that's been one of the areas of the business that we've been working really hard on, with understanding where the weakest point is and what new innovation you can bring in to help mitigate that weakest point for customers. So I think is a bit more complicated than affordability, and I think it is all around trying to get the two markets to work together and to understand the the important bits of the other side of the coin, in effect.
Sure. Les, please, what's your view?
Yeah, it's interesting actually to Alison's view. I mean, I the feedback we get, and obviously we are lifetime mortgage specialists, that's what we do. The feedback we get from advisors, it's very difficult to get them through that affordability. Now, it could just be that they need to maybe spend a little bit more time speaking to Livermore to help them to get over the issues that the advisors face. But definitely from our perspective, from the feedback that we get, affordability on first death or going into long-term care, those are issues that do cause problems for advisors. It tends to be the biggest reason. If you had to name one, that would be the one reason. But I think it's absolutely vital that advisors are skilled and educated and supported by the lenders, whether that be in the RIO space or the lifetime mortgage space. And I think it's really important that the customers have a choice, and where that choice is appropriate and a customer is able to look at RIO, then they should absolutely be offered that chance.
Can I just interject on that for a moment, if I may? I think one of the biggest challenges is, so you're right, people always do think it's affordability, and there has been a lack of tools to help people understand and run affordability. But if you've got a basic affordability calculator, such as the one we've got on our side, you can actually run an affordability check to see what someone's maximum borrowing would be with 6 or 7 questions. I mean, it's really simple and easy to do. And what we need to do is we need to get that information out more so that people will use that and see that actually it's quite a dynamic way of checking what people can borrow, so we overcome it. It's a little bit of a myth that affordability is the only issue, and so I think that's kind of what I would add to that. So,
and I would say, I sorry.
I was just saying, I can see you nodding. Yeah, I'm just going to ask for your thoughts.
Yeah, no, I absolutely agree with Alison. It's and she made the point earlier, and that's what I meant with the innovation as well. I think, bringing some of the mainstream residential advisors to look more into this space and feel comfortable and confident about it is key. I would also say, though, I think customers' perspective have changed a bit over the last 10 years because, before the financial crisis, I think interest only was a bit, I don't know, the norm, or people just, didn't think perhaps too much about it, what it meant to have an interest-only mortgage. And I think the public in general, since the financial crisis, have of course been more educated about it, because lenders in the interest-only space have done much more highlighting to customers, you do need to pay off this mortgage, you need repayment, etc., etc. So I think people coming to that stage are more aware and might have actually got solutions where maybe some of us didn't expect them to have solutions, but they have saved up the money, or they have found, other ways to plan for that moment, and therefore there might not be so much a need as we first thought.
Lovely, thank you very much. I'd now like to move on to a sort of technology question. Have the technology and the processes available to brokers and consumers in the lifetime lending market improved during the pandemic? Is it a needs must? Les, what's your take on that?
Yeah, I think the sector did really, really well when the first lockdown occurred. I think looking at things from a different angle, whether that be technology, particularly on the legal side of the process, I think financial advisors have slowly but now quite readily, in fact, got to grips with things like this. They've got to grips with video calling and stuff like that. And arguably, many of them have found that the process from an advice point of view is now better, because it was quite often difficult to get younger sort of working beneficiaries, children, to meetings, whereas now, of course, that's much, much easier to do. So I think the sector's done really, really well. I wouldn't necessarily say that sourcing has changed unrecognisably. I don't think application processes have changed unrecognisably. I think for most lenders, we were there anyway. So I don't think those things have necessarily changed, but I think how we interact with each other, so how we deal with our customers, the financial advisors, and how financial advisors deal with their customers, the end consumer, I think that's changed. And I don't think we'll see it go back. I think certainly when I talk to my sales team, we talk about our roles being fairly hybrid going forward. And I think it's great for budgets. I think it's great for the economy in terms of how we work within our business. I think it's great for the planet. And I think actually there are some real consumer benefits that have been seen by involving family wherever it is in the world that they are, using technology such as video calling. So I think I don't think we'll be going back anytime soon to the way that life was before.
Don't you love a COVID silver lining? Alison, anything to add to that?
Yeah, no, so it would agree with most things that Les has said there, and particularly interesting for anyone who's running a sales team. You get so much done through Zoom and a lot less driving, which is brilliant. I think for me conveyancing and valuations and broker portals, scan and upload, all has really worked well in the pandemic. I guess for me, the only thing that probably a little bit more innovation I'd like to see would be across sourcing, just the way that sourcing sets itself up for some of the later life lending products, the mainstream sources. I think that would be helpful. If we could look at some a bit more innovation around that, would be the only point that I would add.
And Esther.
Yeah, just a tiny bit. I think it's always helpful. There's been innovation, EID&V and surveys, etc. So that's always good. And particularly if it's the more, administrative end of it, because from, a later life perspective, that conversation, as we've mentioned several times, because of the complexities, because of having to involve family, it's so important to have those quality conversations. So if you can take away and automate the more basic things, the administrative things, that's great. So I think great steps and great progress.
Thank you. How do we provide people with the right advice when 3 different regulatory regimes exist for the mainstream and REO market? The mainstream market, REO market, later life and pensions and investment planning, 3 separate streams. Is referrals to experts the answer, or are there other answers? So that's a really easy question. First to Esther, please.
I think it's a really good question. First, it's difficult to see one person having all the understanding and the qualifications, etc. So therefore, I think the different regimes have led to professionalization, and that's a good thing. But I also do think it's important to look across all those areas for this area of need for customers. And therefore, I believe in partnerships. So making sure that you, when you have an advice business in this space, that you've got friendly partners you can work with to get the best solution for customers. And in terms of referrals, and I know that's not always easy, but that's good. A little bit of build on what I previously said, so that you can make the collection of the data and making that as easy as possible. That's useful. And I also think that networks and clubs can support brokers to smooth off those journeys, to help with that, help to build that, and particularly not just simply refer to a later life expert, but look at it much more in the round and make sure you have those relationships in place.
And same question to Alison, please.
It's a difficult one, isn't it? And I know we talk about this one a lot. I mean, for me, sort of, at the risk of being controversial, what's an expert? And I'm sure that lots of people don't believe that an expert is badged by the number of qualifications they have, etc., etc. And I think it's quite interesting that the regulator sees certainly REO as a mainstream product. And it's important to also remember that pre-MMR interest only was also into retirement was a pretty mainstream product. I think the challenge, as I've said before, is about getting some of the mainstream brokers to understand a little bit more about the pension side of thing, and also to get the equity release lenders to brokers to understand a little bit more about affordability. I think it's a challenge to get customers to take a little bit more control around some of this, and to take a real interest in terms of their planning into retirement. But you know, I don't see what the ideal answer to this is. I know many people think we should have this, you know, this super advisor that can do everything. I'm not entirely sure that sort of cutting down the number of people who are available to help with things is a good thing. I'm not entirely sure if brokers are comfortable with referral. There's a feeling that you're losing your customer. I don't know what the ideal answer is to this, really.
Which is fair enough. Les, do you have the ideal answer?
Oh,
No pressure.
nodding away to Alison, going, yeah, you know what? We've been asking this question for a few years, haven't we? Look, I see a lot of different outcomes. I'm an ex-advisor myself. I've been a dabbler in equity release. I've been an expert, so-called expert in equity release, working for some of the top firms. Look, yeah, I think it comes down to honest human nature, and also regulation and that competency piece. So anybody can get the qualifications. It's not necessarily that difficult to get qualified in mortgages and equity release. A little bit more complicated to throw the pension and the wealth side in, of course. In reality, if you can have those qualifications but still not be competent necessarily, because competency comes from experience. So we need compliance firms, we need networks, we need the national firms to make sure that the support is in place, and the lenders and the clubs and the networks, they have to work together to make sure that those relevant levels of support are in place, so that the required levels of competency are there, whether you're a so-called dabbler or an expert. Because just because you're an expert in equity release doesn't make you an expert in pensions. You just need a generic, reasonably high level knowledge of understanding how pension freedoms work. And the same thing across the way at with Rios as well. So I think, you know, those advisors in the mortgage space need to understand a little bit about pensions, enough to know where they need to ask more questions and get an expert in. Same thing for later life lender, on the later life lending advisors. They need to understand where to pull a wealth guy in, or whether to pull a mortgage broker in to bring in Rio if they don't want to touch a Rio. It's important. I think the one word is teamwork, really. People need to identify, they need to know enough to identify where they need to refer, where it's just, you know, too complex for them. And I think if you can be a general practitioner and still provide excellent outcomes, and I see them doing it daily basis. We get financial advisors picking up the phone to our people and saying, look, I'm phoning around all the lenders, or I'm phoning the clubs because I want to do this lifetime mortgage myself. I've known this customer for 20 years. I want to maintain that relationship, but I want to make sure that they get the right outcome and the best possible product for their circumstances. I see advisors trying to do this daily. So I think I think advisors need to be fairly honest, and I think the networks and the nationals need to be on the ball and make sure that the competency levels are there and the support is there for their advisors. If that's the case, then I don't see any reason why a wealth manager or a mortgage broker shouldn't engage in the later life lending sector. But if it's not for them, please understand enough to know to refer.
Thank you very much for your answers, everyone. Next question. Vulnerability has always been a watchword in this market, and the pandemic's only heightened awareness of older people's vulnerability. Is the FCA's stance on vulnerable customers stifling progress, though, in the later life sector? And if so, how can we as an industry address that? And that's to Alison first, please.
Okay, so thinking about this question, I've sort of come to the conclusion that vulnerability during the pandemic doesn't necessarily follow around vulnerability, you know, being financially vulnerable. I consider them to be two quite different things. I don't think the FCA stance is stifling things. I think we're an industry that's built on taking care of customers. There's always been a very strong ethos, particularly across, you know, the lending and the broking fraternity, that, you know, customers are our lifeblood. I think the thing that we just have to be very mindful of is that vulnerability doesn't just occur in older age. So vulnerability can occur at any point and can take many different forms. So for me, I think that you know, the later life lending market is much more attuned to this for obvious reasons. You know, our customers are older, so I don't think the FCA stance is affecting that. I think that most lenders and most people I speak to have an absolute genuine care for their clients and customers, and so vulnerability is just a part of everyday work. You know, the way we work with people and the programs that are in place to make sure that we capture any vulnerability early and are able to have processes in place to help people. So no, I don't think the FCA are stifling it.
Same question to Les. Thanks, Alison.
100% agree with everything Alison said. I don't believe it's stifling it. I think we just need to be clear and very, very careful this year. As Alison said, you know, people can be traditionally vulnerable, and that might look like a particular type of client, but I think also people can be in vulnerable situations. And I think that the financial pressures that could come this year could lead some people to be coerced by family members because they in themselves are in difficult financial circumstances. So I think we need to be careful to identify vulnerable clients and identify where normal clients who aren't vulnerable are in particularly vulnerable situations, which then in turn makes them vulnerable. So I think it's a moving feast, and I think we'll see. We need to be very, very mindful and careful, particularly with later life lending, as we go through 2021 and into 2022.
Thank you. And Esther, anything to add?
Yeah, just a tiny point. I agree with what everybody said. It's such a key area, so I don't think it's stifling. We all need to, you know, stretch ourselves in terms of, you know, putting ourselves in the customer's shoes. Apologies for the background noise. That happens when you have to move to the hallway to get better Wi-Fi. So what I do want to point out as well is later life can also bring peace of mind for those vulnerable customers. You know, that's an important point to bear in mind as well, that it can provide real solutions for those customers and actually help them when they're in those vulnerable positions to get into a better place. So that's very important to remember as well.
Thank you very much. Now on to our last question, which I would love you to answer as succinctly as you possibly can, because we're running out of time. And that is simply, how much bigger do you think this market could and should get in the next decade? So quite briefly, please. And if I could go to Les first with that question.
10 billion. I mean, I don't know, it's finger in the air, isn't it? But I think definitely we're going to get towards those kind of levels. If we look at the interest only issues that are accumulating over the next sort of 10 or so years, I think we need to be looking at a market of broadly that. A lot will depend on the innovation we can bring to market, but that's what I think.
Lovely, thank you. And Alison?
I'm not going to pin a number on it because I don't think you can. I think there's so many different ways of measuring later life, and how it's recorded makes a massive difference. But I think undoubtedly, is it going to grow? Yes, the demographics and the information show us that there is, it's inevitable that this market will grow significantly.
Great. And finally, Esther.
Yeah, I think there is absolute opportunity for growth because, as we mentioned, you know, pensions, people being equity rich, cash poor, so intergenerational, but also I think brokers maturing, their customers are maturing, so there is definitely the opportunity there for growth.
That's wonderful. Thank you so much to all of my guests today for being such brilliant panelists. Thanks for your answers. Thanks everyone for watching. And we will come back later with another panel. Thanks again. Bye-bye.